Today, we are taking a deep dive into, well, one of the more amplified and, frankly, complex financial tools out there,
Hmm.
leveraged ETFs, or LETFs.
Yeah, definitely complex.
If you've been looking for a way to quickly grasp this stuff,
Mhm.
the promise of big daily returns without needing a margin account, you probably also sense the complexity, especially when you look past just one day's trading. It gets tricky.
Yeah.
So our mission today is pretty clear. Unpack how these funds actually deliver that magnified daily kick, but maybe more importantly, really shine a light on the hidden risks. We're talking about that compounding curveball. It's the key reason these just aren't built for long-term holding.
That compounding curveball really is the heart of it. LETFs are built around like one core idea. Multiply the daily return of whatever they're tracking, an index, a stock. Usually you see 2x or 3x aims for that day.
Right.
But like you said, it cuts both ways. Perfectly. Daily gains get amplified, sure, but so do the daily losses. Just as much.
Okay, let's unpack that then. We need to look under the hood, right?
Mm.
How do they actually achieve that magnification, day in, day out?
It really boils down to what they hold inside. See, unlike a regular ETF that buys and holds the actual stocks or bonds.
Like an S&P 500 index fund holding the 500 stocks.
Exactly.
Yeah.
Leveraged ETFs. They generally don't hold the underlying assets directly. Instead, they tend to use derivatives, mostly things called total return swaps with financial counterparties, like banks.
Okay, total return swap sounds pretty technical. For someone just buying the ETF share on the market, what does that actually mean, that exchange of cash flows?
In practice, it means the fund gets the performance of the asset without actually owning it. The swap is like a contract that delivers the leveraged exposure.
Oh, okay.
But the key thing, the implication of using swaps is that it makes it much easier operationally for the fund manager to do that crucial thing.
Right.
Reset the exposure back to the target leverage 2x, 3x every single day.
Right, so the magic and maybe the danger too is all tied up in that daily reset. So if the fund's aiming for 2x, and say the S&P 500 goes up 1% today,
Yeah.
the fund is shooting for about 2% gain, but just for today.
Exactly right. At the end of every trading day, the fund has to rebalance its swap positions. It needs to square up so that tomorrow morning it starts fresh, ready to deliver 2x or 3x whatever happens that next day. And this whole mechanical process, this daily resetting, that's what drives their unique behavior, this path dependency, when you hold them for more than a single day.
Let's use a concrete example maybe from the source material just to make this amplified daily move really clear.
Good idea.
Okay, imagine you put $1,000 into a 2x leveraged ETF that tracks, say, a popular tech stock. If that stock jumps 3% in one day,
Yep.
the ETF is designed to give you a 6% gain. So your $1,000 become $1,060. You see the appeal there, right? Big gains fast.
Absolutely. That's the hook.
But flip side, if the stock drops 3% that day, the fund is targeting a minus 6% move. Your $1,000 drops to $940. It shows that immediate trade-off starkly. Amplified moves up and down just for today.
It's pure short-term leverage.
So now that we've got the mechanics, the derivatives, the daily reset, we really need to hammer home the contrast. Why are these so fundamentally different from the plain vanilla ETFs most people have in their retirement accounts?
Right. Well, traditional ETFs, they're built for stability for the long haul. They track their index by actually owning the basket of securities.
The actual stocks or bonds.
Correct. They're designed as low-cost, diversified ways to invest over, potentially decades. Their price stays close to the value of what they hold the net asset value, or NAV, because of how authorized participants create and redeem shares.
Okay, so contrast that with the LETFs. They trade easily, just like regular ETFs, right? You buy and sell them on an exchange.
Yep, same mechanism. Creation, redemption, APs, all that works the same way on the outside.
But inside, it's swaps and cash collateral, not the actual assets. And the crucial difference isn't just what's inside, it's the intended use, isn't it?
Exactly. Traditional funds buy and hold. LETFs are generally designed almost exclusively for short-term tactical use. We're talking days, maybe weeks at the absolute most, if you're really careful.
It's a trading tool.
Absolutely. What's fascinating, I think, is how everything, the daily reset, the higher fees you pay for managing those derivatives, and this path dependency we keep mentioning, it all adds up. They're just fundamentally different beasts than long-term investments. They're tracking the price of daily leverage, not the long-term growth of the asset itself.
And that leads us straight into the big warning sign. This is where it gets, well, really interesting and potentially dangerous. The compounding curveball. Why can't I just buy, say, a 2x S&P 500 ETF, hold it for 6 months, and expect to get roughly twice the market's return? Seems logical at first glance.
It does, but it doesn't work that way because of that relentless daily reset.
Yeah.
If you hold an LETF longer than one trading session, its total return over that period won't just be, 2x or 3x the underlying asset's total move.
Why not?
Because the sequence of those daily returns, the day-to-day ups and downs, the volatility matters hugely. You're compounding your gains or losses on a base value that's adjusted every single day back to that target leverage.
Okay, walk us through those path scenarios the sources talk about, because this is where the volatility risk really bites, right?
Right. Let's look at 3 basic market environments to see how the math plays out.
Okay.
First, imagine a steady uptrend. Market just grinds higher, say 1% gain every day for a week. In this case, the fund is compounding on a base that's growing each day. So the compounding effect might actually boost your total return slightly beyond just a simple 2x or 3x of the market's total gain for the week. It can work in your favor.
Okay, that sounds good. What about the downside?
Second scenario, a steady downtrend. Market loses 1% each day. Here, compounding can sort of cushion the blow a bit. Your losses are applied to a capital base that's shrinking each day, so your total loss might be slightly less than a simple 2x or 3x multiple of the market's total drop.
Interesting. So steady trends, up or down, aren't necessarily where the biggest problems lie, though the leverage risk is always there.
Exactly. The real danger, the one you have to understand, is the third scenario,
Which is?
the alternating or choppy market. This is what we mean by volatility drag. It can be destructive.
How so?
Imagine a stock just bounces around, gains 1% one day, loses 1% the next, gains 1%, loses 1%. After several days, the underlying stock might be almost exactly where it started, nearly flat,
Right.
but the LETF, because of the daily reset, it's effectively forced to lock in losses and then apply leverage to a smaller base, or lock in gains and apply leverage to a larger base, constantly reacting to the previous day's move. In a choppy market, this means it's almost like buying high and selling low repeatedly at a micro level.
Ah,
These back and forth swings just relentlessly chew into the fund's value.
yeah.
You can see significant decay, significant loss of value in the LETF, even if the underlying asset itself has gone nowhere.
Wow. That is incredibly counterintuitive if you're used to just tracking an index over time.
It really is.
So the key insight here is that daily reset mechanism, the very thing that guarantees you get roughly 2x the move today, is precisely why your result over multiple days can diverge so dramatically from a simple 2x multiple. The path, the journey the market takes day by day is everything.
Absolutely. It demands constant attention. You need to really understand market momentum or lack thereof.
Okay, so given all this mechanical complexity and the volatility drag issue, who are these things actually built for? When would someone responsibly use them?
They're really built for sophisticated, experienced traders, people who are very active in the market. We typically see them used in maybe 3 main ways.
Okay.
First, tactical trading. Someone has a strong, very short-term view, maybe thinks an index is going to pop or drop sharply over the next few days and uses the LETF to express that view with leverage. Holding periods are often just, a handful of days. Second, hedging. Traders might use the inverse LETFs, the ones designed to go up when the market goes down, targeting NAGA with 1x, NAGA with 2x, NAGA with 3x daily returns to quickly hedge their portfolio against expected short-term risks, maybe ahead of a big economic report or something.
Like a temporary insurance policy.
Sort of, yeah.
Yeah.
A very short-term one. And third, event-driven exposure. Targeting really specific time windows where high directional movement is expected. Think like the 48 hours around a company's earnings announcement or maybe a major central bank decision.
Got it. So for that specific type of tactical trader, the benefits seem clear. You get magnified daily returns, it's flexible for short bursts, and importantly, you don't need to set up or manage a traditional margin account with your broker.
True, those are the upsides for that user. But they only work if you are acutely aware of and actively manage the significant structural risks involved. We should probably list this out clearly.
Yeah, definitely.
Okay, first and most obvious, magnified losses. Leverage works both ways. Small market dips can translate into very large, very rapid losses in your capital.
That's the entry price for leverage.
Right. Second, path risk. That's the volatility drag we just spent time on. Choppy, sideways markets are toxic for LETFs because of the compounding math.
Okay.
Third, there's counterparty exposure. Because these funds rely on swaps, there's a theoretical risk related to the financial institution on the other side of that swap. Now, this is generally well mitigated these days through collateral posting rules, but it technically exists.
Good to know.
And finally, fees. Don't forget the fees. The annual expense ratios on LETFs are usually much higher than traditional ETFs. Managing derivatives daily, the constant rebalancing,
Yeah.
it costs more. So you're paying a premium for that daily leverage, which also eats into returns over time.
Right. So pulling it all together, what does this really mean for you, the listener, trying to get clear on this? I mean, the fund providers themselves are pretty explicit, aren't they? They state these are designed for short-term use.
They do, often right in the prospectus.
So if you do decide to hold them longer than a day or two, you absolutely must understand and internalize that compounding risk and factor in the higher costs. It's not a passive investment.
No, not at all. And yet they're quite accessible, which adds to the potential danger, maybe. You see providers like Leverage Shares offering these 2x daily leveraged ETFs on really popular volatile U.S. stocks. Names like Nvidia, Tesla, Coinbase come to mind.
And they trade just like any other stock on major exchanges.
Exactly. You can buy and sell them instantly. But that ease of access doesn't change the underlying mechanics or reduce that compounding risk over time. It's still there.
Okay, let's do a quick summary then. Key takeaways seem to be: LETFs use swaps to amplify daily returns. That structure demands daily rebalancing. That daily rebalancing introduces compounding effects, making the path of returns critical. Strong trends can help, but choppy markets cause that volatility drag, which hurts performance.
Definitely hurts.
And ultimately, these are tools designed strictly for short-term tactical traders who understand these dynamics inside and out.
Which, raises a pretty important question, doesn't it? Given how counterintuitive that volatility drag is, especially over any period longer than 24 hours. How much calculation, how much strict, unemotional discipline does an investor really need to bring to the table to use these things responsibly?
Yeah.
It's far more like active, high-frequency trading than simple investing.
That's a great point. The source material actually includes a warning, something like, sizing and discipline matter. Set exits and treat leverage with respect.
That sounds about right.
So for you, the listener, maybe the key insight isn't just knowing how the product works mechanically. It's recognizing that using an LETF effectively tests not just your conviction about where a stock or index might go tomorrow or the next day,
but it really tests your absolute ability to stick to a predefined, disciplined exit strategy, especially when that inevitable volatility starts to eat away at your position. That discipline, that execution, that seems to be the critical factor separating potentially successful tactical use from just, well, unintended and often costly longer-term holding. How good are you really at pulling the trigger when your plan says you must?